Excellent. Well, good morning, everyone. Last panel before lunch, our friend Jim Mawson has kindly offered those of you who will sit and persevere through this last panel to get caviar in addition to whatever is served out there. So please sit through. Good things will come out of this. Jumping in and getting us started, let's start with the topic at hand, investing in turbulent economies. And let's start with you, Dina. What should we do in terms of a strategy? Should we be changing our strategy? If, for example, there are CVCs that have been financial first, should they be changing gears and looking at targets for acquisition? Is there something that you're changing about the way you have viewed this job of life that you have?
Sure. Yes, thank you, Farzan. So my name is Dina Ruthier, and I run Stanley Ventures, which is the corporate venture unit of Stanley Black & Decker. Most people know us as a big power tools and hand tools business. Of course, we own the Craftsman and DeWalt brands, but 48 other brands that many people have never even heard of. And we've been around since 2016. We've made 42 investments. So we've learned enough to be dangerous, I guess, at this point. But I would say we don't have the luxury, really, to change our strategy, despite what the macroeconomic conditions are. Innovation is so core to what we do. And if we don't continue to stay on the forefront of that innovation, in the fiercely competitive market in which we play, we will lose market share. And so we don't have the luxury to do that. So our strategy remains what it always has been, which is to work very closely with our business unit leadership teams to understand where their gaps are and where they'd like to go in terms of innovative technology. And then look outside the walls of Stanley for startup companies that have that technology. And then we're a bit unique in the sense that we forge a mutually beneficial commercial partnership at the very same time that we make an investment. And we rarely do one without the other. And so that will continue to be our strategy moving forward because we really don't have any other choice. So I'd say we're staying the course.
Very good, great. Staying the course. And Jeff, for another perspective, since you are actually not a CVC, what is your perspective on that?
Yeah, so I'm Jeff Peters. I'm a partner at a firm called Ibex Investors. And while my last funds raised money from corporates and CVCs, we're very much financially motivated investors. We have a public equity strategy. We have this ability to do one-off deals on the order of $10 to $50 million. But the fund that I manage is focused on the early stage, so first money to companies to Series A, focused on mobility. So we're very focused on that sector. We're thesis-driven, and the motivating, I guess you could say, strategy with the VC fund is that it's called Return the Fund. We want to, any one of our portfolio companies, if the stars align, to be able to return our entire $113 million. And the calculus there has always been, in order to do so, it's a function of our terminal ownership multiplied by what we think the terminal enterprise value could be. Now, with everything that's happening in the public markets and the fact that these companies won't exit for 5 to 8 years, we can't really predict the terminal enterprise value based on current market conditions. But we can expect is that valuations will come down. And that means that we can probably get greater ownership in the companies that we do like, which should increase our investable surface area. So we're actually looking forward to these times as investors, not because we're greedy vulture capitalists, just because we were precluded from investing in a lot of companies simply because the valuations have been too high, even though they're great companies, given our really strict discipline on being able to return the fund. So we're very much looking forward to seeing a lot more companies in the next probably 6 to 18 months. And hopefully we'll find some really good ones out there. And I think that we're actually fairly competitive compared to other VC funds because we do have this public market expertise during these uncertain times, as well as we have the ability to keep deploying capital over the long term, which I think a lot of startups will care about, as opposed to seed funds that will put in $1 million and disappear and hope someone else takes up the reins. So we are staying the course very similarly, but not for strategic reasons, for financial reasons.
Staying the course is a good team. Patrick, thank you very much for flying across the pond to make this. Considering what Jeff said in terms of adjustments in valuations, What do you think people should be thinking, or yourself, in terms of the thesis? Are you thinking about perhaps, since the valuations are changing, you should reconsider which series you participate in, the check size, the target ownership that you want to have? Is there anything that you're changing there or reconsidering? Or
No, so I represent Honeywell Ventures, right? And Honeywell's been lucky, stroke unfortunate, that we're in probably every vertical, every geography. So we had quite a fair bit of notice about the kind of inflationary market of 22. So I actually feel really bullish, because actually we're kind of less worse than we thought we were going to be. And and very similar too, we're sticking to the course, right, around that. So for us, it's all about being a strategic investor, early stage, seeds, A's and B's, and we do follow on where it makes sense, where we're excited about, similar to you, Dina, kind of creating those commercial partnerships that can ultimately lead to some pocket expansion for us, if not even, maybe even form an M&A landscape for us as well. So we're super committed, makes a lot of sense, and for us it's all about thinking about finding partners that can help us understand how the world is going to change in a number of simple ways that are very, I think, macro tolerant, depending where the cycles are, but it's how we work, how we live, how we travel, how we're generating and consuming energy now, maybe even giving back, and then how does all the knowledge get digitally disrupted and delivered there as well. So pretty much the same, so I think maybe 3 strikes here on the same. Yeah.
We'll take 3 strikes. Very good. Laurence, would you like to add to that? Patrick already mentioned flying and traveling, and that's appropriate considering your piece.
Sure, absolutely. So great to be here today. Laurence Vigeant-Langlois, I work with AE Industrial Partners. We're based in Florida. $5 billion under management as a private equity firm, also into venture capital. We were founded in the late 1990s and got into venture capital about a couple years ago as part of our diversification of our funds. So we do buyout. We also do structured solutions with minority equity and debt solutions for mid-market businesses. We do asset investments, so operating leases on aircraft engines. And then finally, venture capital. For us, we really cherish our venture capital investments as a way to get into disruptive, high-growth sectors that really complement our other funds strategies. And as such, we initially made a few investments, then worked on a partnership with Boeing. And as they spun off Horizon X in the summer of last year, we brought in Boeing as a limited partner investor and their investment portfolio over to our firm. And now we manage about 50 startup investments and are growing this with other LPs and into certain sectors. So we're specialist investors as well. We really like aerospace, defense, specialty industrials. And as such, we have a chance to participate across the life cycles of the businesses that we invest in. In this environment, what we're seeing is, again, a renewed appetite for venture capital, whereas, basically as interest rates go up, inflation goes up, valuations come down. To some extent, for us as well, Jeff and others, we see an opportunity to again, renew our interest in seed through Series A for the Ventures Fund, and see an opportunity to be more impactful with the investments we make, right? On one hand, tap into our network, tap into the pilots we can offer with Boeing as an investor, with our other 25 mid-market businesses we own a share or a controlling interest in, and then really, help the businesses grow and potentially, take a larger share of the business as well. So we are, again, continue to be very excited about this market where, from the fundamentals perspective, right, we're seeing opportunities for disruption, whether it's around an interest in climate technology, the unfortunate geopolitical tensions that we're seeing that are favorable to the defense sector at this point, right? Supply chain pressures that create opportunity in enterprise digitization, and the list goes on.
Very good. And let's move to tactics. So in the past 12 months or so, my firm, Plug and Play, we have tried to diversify as much as possible. We have tried to look into Africa and some other places that we have not invested as heavily traditionally. Again, given the changing economy, Jeff, do you think that we should change tactics in terms of where we find the startups, in terms of how we negotiate with them, in terms of how we set up the investment?
Yeah, it's a good question, and very specifically right now we have an initiative looking back within our CRM where we have a bucket of companies to revisit. Maybe they were too highly valued but were really great companies. Maybe they just weren't ready yet. Maybe they closed a round and we were just too late and we wanted to revisit for the next round. This is a really great opportunity to go through that as a firm and identify really promising opportunities where we can top up those rounds given the uncertainty. Or maybe the valuations will actually come down and just be back on their radar. And then another tactic that we're looking into and trying to figure out how to actually execute on is we believe that there's going to be a lot of people leaving the big tech companies, so the Google, Facebook, Apple, et cetera, the world that were compensated mainly off of stock options that now are not worth as much, and in a lot of these employees' views, that was part of their compensation. I make $1 million a year in total compensation. All of a sudden, with the RSUs not being worth anything, or for a while at least, now they're making a third of that. And the calculus for them to start a startup is a lot more interesting. So we're monitoring kind of recent exits of the major tech companies where options were such a large part of their compensation. How to find them is another story, but it's definitely something that we're looking at. Another tactic that we employ is, we always think about how to win deals, especially in the past 3 years. It was challenging. Everybody got into venture, had a little bit of capital, and we're chasing these deals. Valuations got pretty wild, I believe. So going forward, tactically, we need to really make people aware that our position is we have dry powder, we have other pockets of capital that can help you over the long term. We're not one and done funds. We're here for the long haul. And really position us well tactically to, win the term sheets that we want to win.
Very good. So, Dina, any tactics other than monitoring LinkedIn and see who's exiting jobs and quitting?
Absolutely. I have a few thoughts on that, 2 thoughts to be specific. So I would say in this environment, syndication is even more important than it was in the past. Whereas, in the early part of our life cycle at Stanley Ventures, we may have been willing to invest in a company solo. I think we've learned a lot over the past 6 years, and given how important it is to have extended runway to sort of ride out this market environment we're in, I think syndicating and finding good syndicate partners who will continue to support your companies is critical. And then encouraging our portfolio companies when they're looking to raise additional capital to raise more than to take as much as they possibly can raise at this point. Whereas the standard advice has always sort of been, raise enough capital to give you at least 18 months runway. I think I would advise my portfolio companies to think more broader and extend that out. So that is one. And then number 2, I'd say as corporate strategic investors, of which of course many of us in this room are, I think it's an even better time to sell our money plus value to startups, right? To help to get into great deals, because it is through all of those money plus, those strategic benefits that we can bring to the portfolio companies that we can help them get to revenue faster. So for example, with Stanley Black & Decker, when we commercially partner, we often agree to rebrand that startup's technology with one of our iconic brands and then sell that either as part of an existing solution or a brand new solution, which we bring to market through our amazing distribution and online channels. And so that's really beneficial to startups, and even more so in this environment when getting to revenue and profitability is even more critical than it has ever been to do that swiftly. So those are a couple of thoughts.
If I may, I would like to license Money Plus and start Money Plus Ventures.
Okay, there you go.
This will definitely work. Very good. So moving toward a more challenging question, and Patrick, since you're the tallest, I'm going to pose that to you. During challenging times and when companies have faced essentially challenges with their balance sheets, they have drew a red line on their CVC at times. And so what do you think people should be thinking about? What are you thinking yourself to make sure that you have a staying power, as it was mentioned during a few panels this morning too. What should people be thinking about communication, about the way that they show the value to their colleagues, to their CEOs, so that indeed you have a staying power, indeed you'll be around 5 years from now and doing even more than today and giving value to everybody?
Yeah, I think it's super important messaging. Look, there's a big existential threat out there, right? The world is changing fundamentally, and as much as all of us here are very smart companies, we're not smart enough, and we're not fast enough, right, to really deliver where the customer needs are, the big changes. So trying to do it all yourself, or maybe with big bolt-on acquisitions, isn't going to work. And we have umpteen years of trying to prove that. So our venture initiative is really the kind of healthy irritant that we try to be throughout the company. I'm very fortunate that it kind of comes from the chairman in terms of the initiative to do that. We, being all engineers at Honeywell, we scorecard the heck out of it. We all live on reds and yellows in terms of engagement and follow through and traction. And so whether it's $1 million investment or $1 billion investment, we actually take it just as seriously. It's a real integrity and commitment that we've made back to our portfolio companies. So we're not giving up. And in fact, I think history will show that how you get out of these cycles is actually the kind of the real value prop or the real strength that you have as a business to do that. That's what people will remember us for, is how we helped each other get through this. So we're deeper, we're more collaborating. I would say, though, that we've got a little bit more time. We've got more time to do better due diligence, really get to know the founders, maybe spend time with their customers at a level that we hadn't had to do before. Some of the earlier panels that talked about making decisions in weeks and now maybe months. For us, we're typically a little bit more Jurassic. It's probably kind of 6-month type periods, but we're now finding that we've actually, in that period, helped the companies find other syndicate members, like you were saying, Dina. We've helped them get to second or third revenue with other customers to do that. So when we do make the investment, everyone on board internally is very excited. They've had a chance to meet, come out here to the Valley and maybe visit with them. And that's making us be a lot more cogent and relevant to our leadership team. But it does come back to a lot of communication to do that. But we've already kind of allocated the budgets. In fact, our budgets are only down a little bit compared with last year. Anyway, and last year was a super record for us, just coincidentally. So we're actually not holding back on money. And we've even gone back to the board a few times and asked for more. And guess what? We got it. So I feel confident, but it is about communicate, and really help people see the value that you can create together.
I know lots of people who are willing to buy you lunch to learn how to ask for more from the board and get it. Very good. Considering what you mentioned in terms of the commitment that we all have to our portfolio companies, no matter how much we have invested in them, whether it's $1 million or $10 million, given that, again, these startups are facing the same economic realities as large corporations and then some, and perhaps it's even their first time. Some of us have been around for a while. Maybe we have seen a downturn before. And some of these entrepreneurs, this is the first time that they hear the R word, and they don't even know what to think of it. What do you think we should be doing, Laurence, I start with you, to help them, to guide them, to make sure that we are essentially fulfilling the commitment that Patrick mentioned?
Right. I mean, it's our fiduciary responsibility to those companies, right, to do what we can to help them. I think helping find co-investors and syndicates is certainly an area where it's on us to continue networking and really being able to help in this area. I think about managing the business, right, and guiding those entrepreneurs toward smart cash management. To your point, Dina, on the runway, right, until the next raise, if there is a next raise that will be needed, right. If there's a need to right size, to do that earlier rather than later, right, and really have a clear mind as to, again, proving the product market fit, finding the pilots, but from there on, right, managing the business the right way. So I think, in addition to that, from the viewpoint that we bring in with, the operational experience we have, is also help them in any way, whether it's about business development, whether it's about some operational areas where we can help our portfolio companies, across the board. So I think it's really looking at what are the specific needs of each businesses and applying a portfolio of tool set in those areas that can be very helpful.
Okay, right sizing, management, business development. Jeff, anything you can add to that, please?
I think that's fairly comprehensive. For us, that's our pitch to entrepreneurs. We have 800 LPs, high net worth individuals, former founders, executives in the mobility sector and beyond. Helping them find that product market fit through our LPs is paramount. It's what we pitch them on today. It's what we're going to do tomorrow. Find that product market fit so they can bring on new co-investors and follow-on investors. And ultimately surround them with the right people for cash management and business management, whether that's us or people within our network that are better suited for it. That's what we do all day, every day, and we look forward to continuing to do so.
So considering the product market fit, I'm going to go off a script. This morning, I got an email from one of my portfolio companies. He wants to meet on Friday because he wants to change everything suddenly. Should they be panicking? What's your advice? If you were the one going into this meeting on Friday, do you think they should be really rethinking it so quickly, or should they watch, or should they stay the course more? I thought this guy has figured it all out, and now he has panicked and he wants to talk about how to change it.
Well, I think every case is specific to that case, and my personal MO is to find the right person to answer the questions for that particular CEO. It's often the case, well, it's always the case that I'm not going to be the most knowledgeable person. So listen and then find someone that can actually best answer that question, who's been there, done that in a similar sector, in a similar scenario. That would be my best generic advice for you.
And look to validate, right? Customer input in the end. I mean, ultimately the product market fit test is about, does it appeal to solve a problem and help customers?
Yeah, usually when a strategy, you always ask what can go wrong? And what do I need to know, right, to get those indicators? So if you're going to change your strategy dramatically, you've got to ask the same questions, right? What can go wrong with the new strategy, and when will you know it is or isn't working? If they can't answer that, then maybe they need to develop it, but not execute it until they get some other compelling fact around that. So.
But another question is, what can go right to make a very big financial outcome, which is what the financial folks might be interested in as well.
Very good. Excellent. With that, thank you very much, Laurence, Jeff, Dina, and Patrick for joining me. And we shall have some, do we get vodka and caviar or cognac and caviar? Very good. Excellent.
Right,
thank you.
Thank you.